I like this option though because it is allowing more marriages to happen within this situation of buyer and seller, creating more opportunities, more
Yeah,
creative ways to blend and merge agencies. And it's just a playground now that we didn't have before, and
yeah.
great opportunities to expand and grow through acquisition for agencies. And I think this has been needed for a long time, and I'm glad they did it. I am not a huge fan of earnouts, I'll be honest.
Yeah.
Of course, buyers love it because it lowers their risk.
Yeah.
But I'm not a huge fan of it because I think that when you buy an agency, you should have the confidence that you can keep business and grow business. If you don't have the confidence of that and you have to tie it into an earnout, I'm just not a big fan of it.
Percentages be whatever. A good combination because the lenders and got skin in the game. Both sides of the sale have a skin in the game. There's a reason everybody's got a vested interest in the success of the business. It's just not a I'm out kind of scenario.
Bank account is full. You got
Yeah,
money, burning a hole in your
I'm
pocket. Like,
flush.
hey, call me now. Right? I'm gonna
Yeah,
put my number right on the bottom. No.
right, right, exactly. Yeah. I
So
know what I want to buy, and I got the money to do it. Done.
the SBA full buyout means you're buying out all the existing equity and assets of the business, and you're buying out all the owners. In this current state, the SBA rule is uh, you're going to be able to buy them out, but the owners, they can't stay on under as an employee. They can't
Mm,
stay on as a salaried employee.
right.
They can stay there for up to 12 months. After 12 months, they have to 100% exit the business.
Hey, welcome back. Another edition of the Growth Engine with Ryan and Trice. Ryan, what's up, bud? How are you?
Hey, it's summer, and I'm trying to balance life and work and get some time outdoors and fresh air because winter's going to be coming very quickly. You blink and it's here. So I'm trying
Yeah.
to get some exercise in and some sun. And
Yeah, I saw you got some. Did you get some sun here recently? You take a little vacation or something?
southern Missouri, a little, Ozarks, uh,
Nice, nice.
a little country
Hmm.
music, and it's a great thing to do in the summer here in Missouri is to go to the Lake of the Ozarks or
Hmm.
Springfield or Branson, and there's all kinds of river floating to do. So I'm an outdoorsman. I love being outdoors, even when it's piping hot and humid and you're dripping sweat.
Which it is. Yeah, yeah.
So
It's
yeah,
the summer in this part of the world. It's hot and humid. Just
yeah.
it is what it is. So I know we've been talking a lot about this offline, but we've been talking about um, acquisitions, finance, like all these things about around agencies and how people get into it. I know today you've got a great topic about something related to that. So why don't you lay it on us?
So I'm really busy right now in the acquisition side of things. I do have plenty of coaching going on also, but the acquisitions are hot right now.
Hmm.
I have the topic today is ways to buy a digital marketing agency. And there are many ways. And oftentimes when I'm talking to a potential buyer, somebody who's wanting to acquire an agency, they come in with one way. They only know of one way, and that way is a way that somebody has told them to buy it.
Hmm.
And so it's an area that I thought I'd cover today and kind of give everybody like the scope of the options out there for you and try to do it in the simplest way possible because I know it can get more complex than what we're going to cover. But I want
Yeah.
to just keep it simple and just give the basic options that you have to acquire an
Cool.
agency. So first of all, there's a lot of inventory out there right now. Like there's plenty of different types of agencies to buy. Don't feel like you have to search really hard. Like there's going to be an agency that fits your culture and your agency just fine right now. There's plenty out
Hmm.
there. So shop around and look for the right opportunity. And when you do, you need to be ready. And I always say, like, get your financing part figured out first. How are you going to acquire a company? It's no doubt that a lot of agency owners know that merging and buying another agency is a way to get a customer list and
Hmm.
services and contracts and retainers, and it's already on board. And so it's a
Right.
way to grow in a healthy way if you can what they call service the debt or pay the loan back that you borrow to buy it. So, yeah. So I'm going to start with the first one that I have on my list, which is somebody buys an agency. You have the cash to do it. So,
Mhm.
like the
This
bank
is a great
accounts,
problem to have right
the
here.
bank account is full. You got
Yeah,
money, burning a hole in your
I'm
pocket. Like,
flush.
hey, call me now, right? I'm gonna
Yeah,
put my number right on the bottom. No,
right,
uh,
right, exactly. Yeah. I
so
know what I want to buy, and I got the money to do it. Done.
oftentimes these buyers, they have the money to buy stuff outright. You wouldn't believe, the type of money that people have saved away even today. And but then it comes down to the wire where they're actually ready to pull the trigger and they go, no, I'm gonna go buy it with a loan.
Mm,
So they'll talk about using the cash and investments and savings they have, and in the last minute that they'll figure out that isn't probably the wisest move. And
yeah,
most investors will tell you that, like they'll tell
yeah.
you that's not the right route to go. So
Obviously, in that route, right, there's a lot of when it comes to the cost of money and rates. When the rates are low, this is obviously nearly almost somebody else's money that you're using instead of your own, and the debt cost is cheap, so that's always good. A little different right now, but not awful by any stretch. Or just to your point, there could be a lot of tax benefits to not using your own money, because then you can that's an expense you can utilize, obviously. So a lot of people can go a lot deeper than what you and I can on those topics for sure. But you're right, absolutely. Coming in and changing your mind, it's not a find the right mix. So
yeah,
yeah,
yeah.
yeah,
Yeah, so and money is a little bit more expensive now with interest rates
hmm
that have creeped up.
right,
So people are being a little bit more cautious in the acquisition side of things. But
cool,
so
yeah,
there's I'm going to buy a whole thing in cash. That's an option. Another option using cash is I'm going to put a percentage of that cash towards the acquisition, but then I'm going to disperse the remainder of the amount out over a period of time, and basically a note or a loan from the sellers. So
yeah.
they
So
can put 50% down, and the rest of it is a balance that's paid as the agency makes them money, and they use that money to pay back the remainder of
right,
that to the sellers. And so it's an earn out situation. Also, with that can be caveats like that customers, certain percentage of customers stay on board, and that
performance.
performance
Yep.
and profits and things like that. I am not a huge fan of earnouts, I'll be honest.
Yeah.
Of course, buyers love it because it lowers the risk.
Yeah.
But I'm not a huge fan of it because I think that when you buy an agency, you should have the confidence that you can keep business and grow business. If you don't have the confidence of that and you have to tie it into an earnout, I'm just not a big fan of it.
Yeah.
Um,
A lot of people call this seller financing, and so that's the other another term you might see out there in the world about it. Um, it is, in a lot of ways, it does lower the risk for the buyer. Um, and if your seller is interested in this, maybe it's a good option, but because it puts some of the risk on them, they can't. I think from the buyer's standpoint, a lot of viewpoint is um, they're not, the seller's not walking away with some business that's like, been that hasn't been necessarily performing as well as maybe the numbers say,
mhm,
and there's you're putting some risk back on them to leave the business in good form, to maybe be a little bit a part of the business as some kind of a consultant. There's a lot of ways that you can do that, and then yes, to your point, typically a lot of performance things involved here, or at bare minimum, some interest as well as the payment itself. And so
mhm.
there's a lot that goes into this one. This is actually a really, really popular way for people. Um, but your seller's got to be on board for that. That's the hardest part is, but
Sellers, sellers typically
and they
are
don't want to do
not
this.
are
Yeah,
not unless
yeah,
they're desperate. And if a seller's desperate, I mean, it could be family things going on.
sure.
They could be really done and ready to retire and ready to be out of the door, and and that's fine. But yeah, sellers aren't crazy about not getting all their money up front.
Yep.
I like there's a combination here of things that we haven't reached yet that I'll talk about that's my favorite. But cash buyouts don't happen that often. And I would say 5% of the time, or less.
Yeah.
And then cash and earnouts do happen, when it's one to one. There's no banks involved. There's no lender. It's a contract deal.
Hmm.
They get a lawyer to draft it up, and it's done.
Yeah.
They're very easy acquisitions. They're very easy to do, and that's why people like them. It's low cost to get in and do them, and to acquire business. So
In a situation like that, just to ask another question for people out there that don't know, like in a situation like that, where maybe you're looking to come in with some upfront cash, you know, balloon payment, and then break the rest down over 5 years or whatever the number is, with whatever sort of additional things. What's a good marker for a down payment? Is it like 20%, like people who buy
there,
homes? Is it
there
50? Is it
actually
range?
there is no rule. There is no.
Okay.
That's the thing, is you're outside of the
Yeah.
SBA guidelines. You're
Yep.
outside of any guidelines. It's Wild West. It
Yep.
is whatever the seller will tolerate.
Hmm.
I would say what's in good taste is a different question. What's in good what's in good taste is that you put down a minimum of 50%. I,
50.
I would say I like anywhere between 50 and 80, you know.
It probably is, for a lot of people, it's a marker of your level of confidence in the business, your level of sort of um, experience in the finance side of things, to say, yes, I know what I'm talking about when I say 50%, and then also negotiating, you know, your rate, your interest rate on something like that, or your performance indicators are on something like that, or as well as your just the EBITDA numbers and multipliers and all that kind of good stuff. So
Yeah.
we got a whole other bunch of shows dedicated to
Well,
all that stuff down the road. But
when there's an earnout situation, the reason why I'm not a fan of it,
hmm,
uh, it's just that the seller then is relying on the expertise of the buyer
mm-hmm,
to be great at customer service, great understanding of marketing, sales, acquiring business, keeping business. You're basically banking that the buyer has this all the right skills to do this and
yeah,
to go kill it. Otherwise, you're risking everything that you're leaving on the table when you don't get the cash up front.
yeah,
And the truth is you can get to know somebody really well, in a few weeks or a few months. You still have no idea how well they're going to perform in that role.
yeah,
And so it is a huge risk, I think, for sellers to
mm-hmm,
to take on these large earnouts. And I know it's
cool,
real popular when you
yeah,
take courses, when you learn from guys who are deal makers. They love spending time in this area.
yeah,
You can acquire business that way when they're on their knees, when they're really desperate, when they're hurting. And if that's what you're looking for, yeah, you can find those businesses there. Um, Most of the businesses I take on, I won't take them on unless they're a healthy business. I won't take them on unless I know that somebody's got a really good chance of, when they acquire that business, of succeeding and paying back debt, paying back the loan, paying back the owners, and they're going to flourish and have a great journey, owner's journey with that agency.
mm.
That's just my prerequisites. That's the way I roll. I won't take people on that's high risk. I
I think
just,
that's good. And
yeah,
we can get into this. My other question is related to sort of the range, in size for the agencies that you typically try to focus on.
sure, sure. Like the ones I deal with mostly are going to be in the ballpark of a million to 20 million in
Hmm.
revenue.
Revenue. Yep.
Yeah.
Yep.
So they're in that range. So, like, you know, you only have to have, and we'll get this on the SBA, you only have to have roughly 10% down. There's some new rules coming down through SBA that is going to change this game a little bit. We'll talk about that.
Cool.
But yeah, I handle agencies in that size. Most of them are in the 3 to 5 range, and so that tells you the size that agencies can get.
Yeah.
You
Yeah.
don't find a lot of agencies that are above that range. You just don't find a lot of 50, 100 million dollar agencies out there
No.
that are for sale. Usually
Yeah.
when they're
They've already
acquired,
been acquired at least once by that time. Yeah.
when they're acquired, it's really usually behind closed doors. It's not usually a public thing. So
Yeah. Yeah.
yeah.
Yep.
Um,
Okay.
so the next one is a traditional bank loan.
Okay.
These are very rare because the interest rates are higher. But people do it. They'll go to the bank, they'll borrow it. They know somebody that, their bank at the bank that they'll loan them the amount. And usually these are smaller deals that they can go and borrow and pay cash out for.
Yeah.
So like they'll just get the cash from the bank and go pay it that way. So
Wow.
they don't have the money in the bank or they don't want to use the savings they have, but they want to just go borrow in a traditional loan.
Yeah. And traditional loans like that, in comparison to something else, are they short commercial loans, like 5 years, or is it typically like a 10-year kind of thing?
Usually they're shorter.
Yeah.
Usually they're in the 5-year range,
That's what I
10
figured.
years max. Like it's kind of hard to get them to string out a large purchase like that,
Yeah.
large amounts.
Yeah.
It's higher risk
The
the longer
same the same thing as
they do
like a
that.
seller. Like
Yeah.
because if the economy turned and rates went changed for them, they're
Hmm.
technically losing money because they loaned money to you at a lower rate. So
Yeah.
yeah,
Yeah.
yeah.
Yeah. So these just don't happen very often. Usually the interest rates are too high. But the good news is if you do cash or you do a traditional loan from your bank, you don't have to go through SBA guidelines. You can get
Mm,
around them and you can actually create deals and form deals however you want to. And so you have a lot more flexibility in how you construct that deal. Um,
okay.
so now that we got the ones out of the way that aren't very popular or typical, we'll talk about the ones that are the biggest ones. So
Okay.
most small businesses are acquired through an SBA loan. Um, I'm not an SBA lender. I work with SBA lenders, and I know the general guidelines for SBA that we work within. When I do a valuation on an agency, I will create that valuation, assuming that it's going to be acquired through an SBA loan.
Hmm.
So that's one of the things I'm looking for before I take a business on or an agency on to sell it is I want to make sure that the profits and everything else is there, that it actually will go through an SBA approval for a loan.
Hmm.
And so they're looking for a certain amount of EBITDA. They're looking for cash flow. They're looking for things like is the buyer are they experienced in this industry? Can we put our money on this deal? Can we
Hmm.
really feel like we're going to get that money back? What's the risk factors? And there's a whole lot of detail that go into that. But they do look at a lot of the history of the agency and the history of the financials. And so we spend a lot of time in due diligence working with the lenders to try to get all that information to them so that they feel confident in approving the deal and structuring that deal.
Is
So
that the kind of work you do up front, or like once you get into a relationship with somebody who wants to sell their agency or buy an agency for that matter, is that the first thing that you put together as from
we
the financial
we
standpoint?
do put together a marketing kit, and that includes the bulk of what SBA requires. There's
Cool.
always additional things that each lender will want. And so we don't go that far. We'll usually wait, sit back, say, okay, what else do you need? And then
Mm.
we'll go get those reports. Oftentimes we have them already because a potential buyer has already asked for those
Yeah.
details.
Yeah, I
So
think later on another show probably. I think it'd be really cool to talk about um, EBITDA and cash flow. Like, what
mhm,
do lenders really look for? Because those are the two measurables that everybody looks at when they're talking about the health of a business
yep.
and the price of a business. And people talk about multipliers all the time, and it's different from industry to industry. But a lot of that is sort of some number somebody just picked out of the sky,
Yeah,
and people
it
don't
is.
understand how they got there. And
Yeah.
there's no benchmark that's like your industry's 5x or
And there
20x.
is
It's
no
all
calculator. There is no
no,
calculator for it either.
right.
You will run into mergers and acquisitions companies. You'll run into brokers who will claim they have the calculator.
Yeah.
They don't. There is no calculator for the industry. It is the way they perceive it. They can say,
Yeah.
well, it's based off of lenders or an SBA, but at the
Yeah.
end of the day, however that calculation comes out, is a calculation that they deem
Yeah.
is the right calculation. And like it's no two are the same situation as
Yeah.
far as
And
how they configure.
I think the thing that people relate to the most is when they buy a home, right? Somebody does an appraisal on your home during the financing process. They go out and they get comparables. They look at people that are, certain geographic space from the home you're buying, size, style. comparables, right? And then they tell you three of those were sold in the last however much time frame. So
Right.
they've got a really good benchmark of saying, we know it's right in this lane right here.
Right.
Well, business, they try to do that same thing, except all that data is private. So they can't get in most of it. And so the only ones they can get are public transactions, which are public entities for shareholders,
Right.
not comparable in any way, shape, or form
All we
for
can get
people that are
is
in small business.
all we can get is the listing price and the ratios or the multipliers they used at the list time of listing, not when it
Actual
actually was
transaction.
acquired, not the actual deal that went through. And
Right.
so that is the biggest difference. I'm glad you pointed that out. Um, with just sort of cover the SBA without going into all the SBA guidelines and rules. The SBA situation, there's two types. I'm going to talk about the first one, which is the full buyout. The SBA full buyout means you're buying out all the existing equity and assets of the business, and you're buying out all the owners. In this current state, the SBA rule is uh, you're going to be able to buy them out, but the owners, they can't stay on under as an employee. They can't
Mm,
stay on as a salaried employee.
right.
They can stay there for up to 12 months. After 12 months, they have to 100% exit the business. Okay. So
Interesting.
that's the current guidelines. Now, in that, they get paid a consulting fee or a
Mm,
transition fee. That's used different terms. It depends on the situation or
yep.
the broker. But it's a transition fee. It's a consulting fee to make sure that the handoff is smooth, and so that is usually somewhere close to the salary of the current owner. If the current owner's salary is inflated, then it obviously will come down. But if you really need them to stick around and they've been taking a low salary, you might increase it. So it is a little bit of a variable there, but you pay them a fee. It's usually per month. Don't get crazy. You're not going to pay them commissions based off sales during that time. You're not gonna pay them a bonus structure stuff. You're going to pay them a monthly consulting fee, and that's what you got for that 12 months. Okay.
Yeah.
So
Interesting.
that that type of loan, they the lenders want a 20% gap. The 20% gap can come in several ways. My favorite is a 10 and 10. So I like to get 10% seller carry. You talked about seller carry note.
Mhm.
I like the sellers to offer up at least 10% seller carry note. That takes care of 10%. And then the other 10% is a down payment from the buyers. So 10 and 10, that's the 20/20 gap.
Mhm.
Okay.
So they carry 10, you pay 10, and 80 is SBA financed.
That's right. That's right.
Interesting. I like that. Yeah.
Yeah. So everybody kind of wins in that scenario because that seller
Yeah.
note does mean that the sellers do have a vested interest in your success moving past that, and they want you to succeed. So during the term of that seller carry note. So that seller carry note can be any terms. It can be any length of time that you would have to carry that. Usually there's a delay period where they'll have to wait for a year or two before the buyers have to start paying that seller back that
Mm,
amount. Okay, and so they might have that runway after they buy it to kind of get the agency up and running, and then they start paying that back. And that time frame can be as little as 3 years. It could be up to 10 years. Like that is more up to the lender to determine what that seller note distance should be. They have calculators, and their calculators tell them what is low risk and where they can actually service the debt, pay the loan back, the SBA
right.
loan, and the seller note both. And so they
Yeah.
want as much runway as they can get to make sure that that new business owner and the new agency owner is going to have plenty of time for success in
Yeah.
getting new clients and getting profits generated and really kind of get set up to be able to pay that loan debt back.
Yeah.
So
I like that combination a lot. And, percentages be whatever. The good combination because the lenders and got skin in the game. Both sides of the sale have a skin in the game. There's a reason everybody's got a vested interest in the success of the business. It's just not a I'm out kind of scenario. Um, and whatever you didn't learn in your due diligence, you will, and they're there to help you
Right.
obviously, because there's absolutely going to be stuff like that that comes through. So, yeah,
Yeah.
I like it. Yeah,
Yeah. So, you know, this, this is the best way to have it. 95% of the time, like this is the way it goes down. Like it's an
interesting.
SBA loan. And so, that's my favorite. The next one that I'll talk about, the last one I'll talk about today is the new changes coming up August 1st.
Hmm.
The SBA has changed some rules. So a lot of agencies are not single owners. They're,
Hmm.
they have
Amen.
partners.
Yeah,
So like law firms, they have partners, and there's,
absolutely.
sometimes two, three. And so in that situation, they had to all leave if the company was acquired. They had to all leave. The
Even
new
if they were small percentage owners, they would have to leave.
Yeah, I mean,
Yeah.
so whatever percentage of equity or shares they have in that ownership, they all got to go. The new rule says it's called a partial buyout. The
Mm.
partial buyout allows an existing owner or owners combined to stay on board as long as their equity is 20% or less. So
For the
they can
total.
they of the total amount, right?
Yeah.
So they can keep 20% of the shares and equity in the agency. And what it does is it really lowers that price for the
Yeah.
buyer.
Yeah.
It creates all kinds of great opportunities that we
To
didn't
get
have in
into
the
something.
past.
Yeah.
The risk obviously is that is somebody's buying this agency and they don't know the partner that's staying on board and they've got equity in the company. Like you don't, the risk is you don't have this relationship. You don't know how that relationship's going to go. That's the risk involved in that situation. And
Sure.
so you've got to, interview that person, maybe spend some time with them, out of the office, maybe
Yeah.
maybe do a few things together, go hang out, see
Yeah.
how well you get along before that happens, because you don't want something to go south after that because they own a part of your company still, right?
Yeah.
So I like this option though because it is allowing more marriages to happen within this situation of buyer and seller, creating more opportunities, more
Yeah.
creative ways to blend and merge agencies. And it's just a playground now that we didn't have before,
Yeah.
and great opportunities to expand and grow through acquisition for agencies. And I think this has been needed for a long time, and I'm glad they did it. So
Yeah.
they're
It's funny. We were talking before the show about, some podcasts I've just listened to on this topic recently. And, you know, the, I think the thing for people who really think about um, wealth and abundance and prosperity as a whole, rules like this allow you to get into partnership with people much easier,
Mhm.
um, get involved in established businesses. Um, even, let's hypothetically, right? Like even if an owner wanted to get out of the business, but only wanted to sell you 80% and they're a silent partner, right? Like,
Yeah,
okay,
it can
like
happen.
there's just a lot of combinations here that allow ownership of something to happen, which,
Right.
as people think about their future wealth, going from being involved in something as an employee and owning it are just worlds apart. And I think it's great as people get into this more, and especially considering the cost of things is so much more than it used to be. And I'm sure evaluations on agencies, while there are thousands of them available or out there, and many of them I'm sure are available. I'm not saying they're a dime a dozen because they're not, but it allows people to get into it
Yeah.
and be a part of it, and not have to feel like they got to start from scratch to do
Yeah,
something.
think
So
about this also, current employees at the agency,
employee ownership,
they now have
yeah,
an opportunity, somebody wants to buy it, they now have an opportunity to get an SBA loan, only have to have 10% down,
yeah,
type of situation. And actually with this new rule, and we're waiting to hear some details. We're still sorting out some of the details. I'm hearing as low as 5% down. So
wow,
if they actually can come in and do something like that
yeah,
and put that money down, it allows them to buy it from the existing buyer or from the existing seller and agency owner
yeah,
and take over. And that's not been something that's been available before. And I love this opportunity now because that situation is happening a lot in agencies where somebody's totally qualified to run the agency,
yeah,
and their right hand person, current VP of operations or marketing director, creative
yep,
director, they're in a position where they actually understand the agency and the clients, have relationships, and taking it over is really, it makes a lot of sense to keep it going. And existing owner can ease on out and still get paid and have more confidence in how that agency is going to be ran. They know the person.
Yeah, yeah. That
Yeah.
that's I mean, an agency life. That's ideal, right there. Is
Yeah.
I've got somebody, I made them a partner. They own, I gave them equity. They own some small fraction, and now, and with the idea that eventually they would buy me out. And now you have a little bit of flexibility built into the system where, well, buying me out maybe only means they have to buy 80%, and or we're going to do this in chunks or something, whatever. And you're right. And also I'm not forcing them out because they can stay involved in the business, and it's good for me as as a new buyer that they have a relationship and can stay involved because they own 20%, and
Hmm.
they can still be a inspirational leader or figurehead or go to some client meetings because of their and help with that transition. There's a lot right in there,
Yeah,
and so
all kinds of these combinations now are available
yeah,
to happen.
yeah,
And when you think about that, it's just so awesome that you can actually almost form your own deals at this
yeah,
point. Before this happened, you're dealing with high risk, meaning you're having to actually somebody has used all their cash, or you have a situation where basically they they have to use their money in an earnout over
mm,
time,
yeah,
and the current owner doesn't get any big cash up front, and that's not good. I mean, that again, nobody
yeah,
really wants to do that. Sometimes they do it because they really wanna have somebody else take it over, and that's really the only option they've got. So
yeah,
this solves that problem.
yeah. I like that. That's a good point. Legacy,
Yep.
right? Like a lot of people are like, I'm hand picking the person I want to carry on for me.
Yep.
I'm still involved in some combinations. The downside is I'm going to retire, but I didn't get any big cash payout. Now I got to take it over 5 years or 10 or some number in between. And you're like, that's great. I mean, it's very, a great mentoring type of relationship you probably have with somebody. But at the same time, I'm sure you put a lot into it and you'd love to get 50% out right from the get go, right? Like, pay off whatever a big chunk of that is, and let them enjoy life a little bit and then still have something to look forward to over the next 5 years or whatever. So yeah, I see that. I see that.
Yeah.
So
So I think what'd be really cool is after August 1st, after these rules change and after maybe
yeah,
some deals have gone through,
coming
and
up.
I'd like to have I've got a couple of friends that are SBA lenders. I'd like to have them on
Yeah.
the show and go deep on
Yes.
this topic because I
I
think it's
love
really
it.
important when people can use other people's cash other people's money to buy a company. When you can use government money and
Yep.
to do an acquisition,
Yeah. Right.
it's great. So I
Yeah,
love this topic.
I think finding out, topics like, how you find these kinds of businesses. Why, how do you use a broker to help you get into something, let alone get out of it? Um, Things like that. How do some of these performance-based sort of payouts work? What they look like, all that stuff. It's valuable information because it's not out there, to be honest, and it's not relevant to agencies, which is interesting. And I think if you're an agency owner right now, you're right. There's a lot of people our age who've been working in an agency for a long, long time. They probably should be owning their own thing if they don't already. And there are a lot of people that are aging out that are in their 70s or 80s. They want to get out, and they've done everything they possibly want to do in this industry. And it's good timing for all that. Plus, there's a lot of young people who,
Well, it's great timing. They don't have to learn
yeah,
AI. They can get out and not have to learn all this AI stuff coming down.
no doubt. Yeah, right. And then there's a lot of young people who are like, I've been freelancing and I don't know if I should um, start my own business as an employer. And maybe this is how they get into it. They want to just acquire something that's a 5-person team and grow into it. That okay. There's a lot of things out there now
I
that are
mean, think about that. I worked, 11 years growing my agency to point where today, if you have, a couple $100,000, you know, Not everybody has a couple $100,000, but if you have it, um,
right?
you can buy your way into what took me 10, 11 years to grow
Uh, yeah,
instantly,
I mean,
instantly.
you and I talked about this before. You're a video agency and you need SEO. You're a
Mhm.
digital agency, you need video. You're a PR agency and you need SEO, whatever, right? Like
Mhm.
there are so many combinations now that exist that are interesting together. And you know, the day of the full service agency being non-traditional media, and marketing strategy, creative, as well as all this digital stuff. Oh, and PR. That doesn't exist, right? Like there's
Yeah,
no thing that's all of that. It's just too big. And
yeah,
so, but in a small frame, if you're like, hey, we grew this thing, now we want to add this thing so that we can be a little more full service. This is a great time to do it.
yeah. I want to paint a picture, a scenario here as
Yeah,
kind of the last thing we do is, so let's say there's an agency for sale for 1.5 million. Okay. Agency for sale, they roughly produce 1.5 million in revenue, but
right.
they're set for sale for 1.5 million. Okay. The current owner is drawing a salary of $200,000. Okay. They're drawing $200,000 for themselves, you
Yep.
know, and they have owner benefits like it's paying their insurance and maybe some trips. I don't know. It's
And
like,
that doesn't even count whether it's profitable beyond that, and there is some owner equity in there. You know, we're
so
not even that far down the road. So
so
yeah,
they can go if they have $150,000, they can go buy this $1.5 million agency with that 10% down. Okay. They can leave whatever job they're currently have. They instantly start making 200 plus $1,000 on the salary from now taking over what the other owner had. They can instantly replace their salary, make more salary. Okay. They can pull out the loan. Yes, they have to pay the loan. This is
yeah,
true. You can grow that agency. You can grow that 1.5 agency in a few years. Let's say you grow it to 3 million. Okay. You grow that to 3 million. Okay. Then you can put it back on the market in 3 or 4 years and really make a lot of money. Like now we're talking about some serious money, right? Now we're talking about some life-changing, generational changing type of money and revenue that you're going to be receiving. So
yeah,
that's the thing I would tell you is there's all kinds of ways to make money by acquiring agencies, buying and selling agencies, and being in that part of the growth side for your agency is
yeah,
more than one-off project, one-off clients, and retainers. There's more to this world. There's more to this world than what people realize.
yeah,
It's fast growth, and there's way more money involved in that side of it than if you're just running the agency. So when somebody's ready to go, that's when they're ready to go. Give me a call. Let's talk. I'll talk to you ahead of time, years ahead of it. Let's have discussions. Like you need to do it as far in advance as you can. When you're starting to think about it, I can help you align your current agency. I can help you start preparing your current portfolio financially to buy one, and we can have that discussion so that you can do it with ease and really have a great journey as an agency owner financially and just have a lot of fun doing it. I enjoy
yeah,
the agency world. It is a lot of fun. Can be stressful, as everybody knows, but there also can be big payouts if you do it right.
yeah. Absolutely. Awesome, man. Love it. I can't wait to talk on future episodes about all the details that are coming out and combinations of things. I think there's a lot you can dive into, um, to help people get ready to buy and to sell.
Yeah, I
Yeah.
agree. I agree. Well, thanks. If you learned something from today, please hit like and please subscribe for future episodes. We appreciate it, and we will see you next time.
Take care.